In 1990, the ground beneath Tokyo was considered the most valuable real estate on Earth. Not the towers, not the neon, just the dirt. People joked that the Imperial Palace was worth more than all the land in California. And the joke only worked because it felt true. Taxi drivers quoted land prices the way gamblers quote odds. Salarymen swapped square meter figures like baseball stats. Bankers smiled as if gravity had been repealed. Then the bubble burst. Equity screens bled red, land prices bent, and yet the story didn't end the way bubbles usually do. The crash didn't clear the wreckage. It lingered. It hardened into habit. It became a system that refused to die, an economy that kept moving while standing still. What do you call a collapse that never finishes collapsing? This is where money, power, and history collide, and nothing is ever as simple as it looks. The late 1980s asset mania in Japan is not just an artifact from a distant decade. It's a manual for how a rich, disciplined nation can drift into a financial winter and then decide, consciously or not, to live there. The lesson isn't merely that bubbles burst. Everyone knows that. The real lesson is how institutions keep the patient breathing after brain death, and what that choice costs the households who wake up every morning inside the machine. The fuse was set by success. Post-war Japan built prosperity with industrial policy that prioritized exports, craftsmanship that made in Japan a global signature, and a dense corporate web known as keiretsu, banks, manufacturers, and trading houses bound together by cross-shareholdings and long memories. Credit served production. Banks were guardians of long-term relationships, not coin-operated risk kiosks. That was the ideal. But prosperity attracts pressure, and in the mid-1980s, the Plaza Accord pushed the yen sharply higher against the dollar. Exporters winced. Policymakers reached for the universal cushion: lower rates, easier money, more credit. Deregulation nudged banks to lend more aggressively. The postal savings system vacuumed up household deposits and funneled those savings into the broader financial bloodstream. A culture that already treated land as the ultimate store of value suddenly had access to credit at a price that felt like a rounding error. The loop snapped shut. In a market where land is the favored collateral, rising prices don't just create paper wealth, they create more lending capacity. Appraisal up means loan up, means buying up, means appraisal up again. The balance sheet becomes a merry-go-round and nobody wants to be the one to step off. In that world, risk measurement collapses into a single question: what will tomorrow's appraiser say? As long as you believed the next stamp would be higher, any price made sense. Bankers who once judged borrowers by cash flow quietly shifted to judging them by acreage. Companies borrowed against property to buy more property or shares. Households stretched ratios their parents would have called irresponsible. Construction cranes became weather vanes, pointing to permanent fair weather. Newspapers printed charts that looked like rockets. It all felt rational because it felt unanimous. If you want to see the psychology of a bubble without the noise, picture a circular mirror. One side reflects land values, the other reflects credit. Each convinces the other it's real. People stop noticing that a mirror can't support any weight. They place their future on reflection anyway. There was an international dimension. The Bank of Japan had eased after the currency shock, and global investors, dazzled by the world's most efficient corporate machine, poured money into every Japanese asset they could reach. If you wanted safe exposure to the miracle, you bought land-rich companies. If you wanted leverage, you borrowed to buy the land itself. Monetary policy could have leaned harder against the mania, but doing so would have meant ending a party that seemed to be lifting all boats. By 1989, the central bank finally tightened. Interest rates rose. At first, that felt manageable. Then, the most fragile asset reared its head: confidence. People recalculated. The appraiser blinked. The Nikkei rolled over. Equity cheerleaders ran out of euphemisms. Land prices didn't fall off a cliff at first. They just stopped descending. That was enough. The machine coughed. Deals that were penciled only because tomorrow would be richer ran out of tomorrows. Bankers discovered the cruel algebra of collateral-based lending. The asset you relied on for safety becomes the instrument of your destruction when the line moves against you. Margin calls. Refinances denied. For sale, signs that became part of the scenery. A textbook market would have cleared at lower prices, new owners would have taken the keys, and the economy would have endured a brutal season before planting new ideas in freshly priced soil. But that isn't what happened. What happened was evergreening. Lenders extended new credit to failing borrowers, so those borrowers could pretend to service old credit. If the loan paid interest, the bank looked solvent. If the bank looked solvent, the regulator could sleep. If the regulator slept, politicians avoided a headline that included the words panic and bank run. Insolvent firms refused to die because death would have forced someone to admit past mistakes. Construction companies with no profitable future stayed alive. Retailers with no customer growth kept their doors open. Real estate developers with negative equity kept paying interest with interest. And an economy that should have had a short, savage purge settled into a long, polite stagnation. The zombies marched. It wasn't only the borrowers. Banks themselves functioned like haunted houses. Losses were hidden in the attic. Off-balance sheet structures disguised the smell. Special inspections forced a few write-downs, but not enough to scare everyone straight. Public funds sliced into asset management companies designed to warehouse bad loans. The financial system became a museum of denial, where yesterday's errors were preserved behind glass with a plaque that read, "Do not disturb." The visible collapses made headlines. A storied broker shut its doors and bowed on national television, saying the quiet part out loud, "We are to blame." Long-Term Credit Bank was nationalized and later reborn under foreign ownership. Another lender from the north vanished. Each failure should have been cathartic. Instead, each one revealed new layers of avoidance. Promises that weren't promises, assets that weren't assets, collateral that was just a memory. The market's verdict stretched across decades. Equity indices haunted their former peaks like ghosts who couldn't find the exit. Land prices drifted down in slow motion, street by street, neighborhood by neighborhood. A myth died not in a headline but in a ledger. Underneath the surface, the deeper mechanism tightened its grip. Households and companies looked at their balance sheets and made a collective decision. Never again. They paid down debt. They hoarded cash. They guarded against risk as if risk were an insult. When one family does this, it's prudence. When every family does it at once, it's paralysis. Demand evaporates. Investment stalls. Prices sag. Deflation isn't an event. It's an atmosphere. Even at zero interest rates, nobody wants to borrow because debt is no longer a tool. It's a trauma. A central bank can lead a horse to liquidity, but it cannot make it drink when the stable still smells like smoke. Fiscal policy tried to fill the hole. Government budgets expanded. Bridges were built. Roads were paved. Stimulus packages arrived with ceremonial seriousness. They prevented depression. They did not restore vitality. Because you can stimulate your way out of a balance sheet recession when the private sector has decided to repair itself. You can only stabilize the patient and wait for the will to live to return. Waiting took a generation. Monetary innovation turned the entire planet into Japan's student. Zero interest rates were only the beginning. Quantitative easing followed. Then yield curve control. Then buying equity funds and real estate trusts so that markets wouldn't fall apart under their own doubt. Did it work? It stopped the bleeding. It stabilized the banks. It kept asset prices from telling the full truth too quickly. But there's a cost to turning the central bank into the largest whale in the pond. Prices lose informational content. Investors focus on the shadow of policy rather than the pulse of profits. Capital allocation is measured not by expected return, but by expected intervention. The longer it lasts, the less anyone remembers how real risk-taking is supposed to work. In the 2010s, a different kind of experiment arrived. 3 arrows promised liftoff, monetary expansion, fiscal push, and structural reform. The first 2 arrows flew straight and fast. The currency weakened, stocks rallied, corporate profits improved on paper, and the mood brightened. The third arrow, the one that required changing habits, loosening rigidities, trusting entrepreneurship, drifted. Demographics didn't clap. An aging, shrinking population absorbed stimulus with the wary calm of people who have seen a storm before. Labor markets tightened, but wages refused to sprint. Households stayed careful. Corporate treasuries kept cash mountains because yesterday's memory was louder than tomorrow's dream. The bubble's ghost sat at the boardroom table, an uninvited advisor with a single line of counsel. Whatever you do, don't break the balance sheet again. Numbers miss what this does to people. Teenagers grow up in homes where property is no longer a ladder but a millstone. Middle managers learn that loyalty buys security but not advancement. Founders discover that failure is a scarlet letter, not a lesson. Prices don't rise, apologies do. You don't quit, you endure, you don't bet, you conserve. This is how an economy can hum with activity and still feel like a paused song. Don't panic, not a crisis. Sclerosis, polite, careful, endlessly extended. If this sounds like a museum exhibit, it isn't. The pattern repeats wherever credit inflates collateral, collateral enables more credit, and banks confuse rising appraisals with risk management. A coastal condo market convinced that waterfront scarcity is a law of nature. A sprawling inland apartment boom financed by shadow banks that promise safety until one developer misses a payment. City budgets are addicted to land sales. Pension systems invested in the assumption that prime assets are immune to gravity. The names change, the math does not. The warning is simple. Choose your pain. Do you want a sharp correction or a long coma? The sharp correction hurts now. The coma hurts for 20 years. What actually works after a bust is the opposite of what fear recommends. Recognize losses early. Insolvent institutions must be resolved, not coddled. Protect depositors, wipe equity, recapitalize cleanly, and replace management that drove into the ditch. Let prices find new owners. Assets need to clear to hands willing to invest, rather than merely to hide. Aim stimulus where balance sheets are broken. Households and firms that can become customers and innovators again if you relieve the debt anchor. and rebuild animal spirits by permitting failure without exile. Entrepreneurship requires cultural oxygen. If every fall is a permanent stain, capital hides in savings accounts and share buybacks forever. For ordinary people, the lesson is brutally practical. Don't let rising collateral define your life. A home is shelter first, investment second. A stock is a claim on profits, not a promise of enrichment. Debt multiplies outcomes, good and bad, and in a bubble, the losses arrive faster than the gains ever did. Diversify across realities, not merely tickers. Keep skills that travel with you, cash you can actually reach, and assets that don't rely on a single appraiser's blessing. In a crash, liquidity is a superpower. In a stagnation, patience is. There's also an awkward truth worth saying out loud. Collapse is not only ruin, it is transfer. From the many who trusted the reflection to the few who owned something real, from passive savers to active buyers, from institutions that refused to confess to institutions that were forced to be honest. This doesn't have to be predatory. It can be restoration if price discovery is allowed to do its job. Markets aren't moral. They are mirrors. But unlike the bubble's mirror, they eventually reflect weight. The Japanese experience carries one more uncomfortable implication. Central banks can stabilize. That matters. They can prevent spirals that shred livelihoods. That matters more. But when stabilization turns permanent, when the buyer of last resort becomes the buyer of most, the line between medicine and diet blurs. A society can live on intravenous nutrients, but it doesn't build muscle that way. Muscles grow by bearing weight. Economies grow by bearing risk. If policy makes risk taboo, the future shrinks to fit the present. None of this diminishes the miracle that came before or the virtues that still define the country. Discipline, craft, and social trust are strengths. They also make denial easier because denial feels like duty. The older generation remembers a time when land never fell and wages always rose and permanence felt like a birthright. The younger generation has to build a vocabulary for a different world. That transition is cultural as much as financial. A culture that permits experiment is a culture that permits error. It's not disrespect. It's the price of renewal. So, what do you call a crash that never finishes crashing? You call it a choice. Not a single decision on a single day, but 1,000 cautious approvals that all point in the same direction. Extend that loan. Defer that write-down. Add one more program. Avoid one more headline. And after a while, the choice becomes a landscape. People raise families on it. Companies plan around it. Politicians promise to maintain it. Nobody remembers that it began with a refusal to admit what already happened. The mythology of land as a guaranteed store of value has been reborn in other places, under new flags. You can see it in brokers who treat square footage like scripture, in lenders who treat appraisals like armor, in governments that treat rising prices as proof of competent rule. The cycle always rhymes. Credit chases collateral, collateral feeds credit. A smart person finds a statistic to justify why this time is different. And then one morning the statistic stops working. Japan's bubble didn't simply burst. It evolved into a policy regime, a corporate temperament, a national memory. That's what happens when a financial system can T-bear. To say what it did out loud, the bill doesn't vanish. It accrues interest in time and opportunity in lives lived narrower than they could have been. Politicians will talk about soft landings. Central bankers will promise engineered stability. Maybe. But if the price of stability is decades of drift, the only honest question is which pain you prefer. The clean break or the slow fade. There's a final irony worth keeping close. Modern finance has a way of turning debt into money and money into mood. For a while, the mood was invincible. Then the mood became careful. Mood is not trivial. It determines whether a young engineer quits to build a company or stays for a safer title. It determines whether a family moves to a new city or holds tight to a house that isn't worth the mortgage. It determines whether a banker writes the loan that funds a future or extends the one that perfumes the past. When the mood changes, you either clear the wreckage or you build a museum around it and sell tickets to your children. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.